We are living in a period of extraordinary economic contradiction. On the surface, markets appear resilient, stock indices touch new highs, technology continues to innovate at breathtaking speed, and global liquidity still circulates at enormous volumes. Yet beneath this optimism lies a growing unease: inflationary pressure, mounting debt, currency dilution, and increasing distrust in traditional financial systems. It is within this environment that outspoken investor and author Robert Kiyosaki has once again captured global attention. Known widely for Rich Dad, Poor Dad, Kiyosaki has never shied away from controversial forecasts. Recently, he made one of his boldest claims yet, that silver could rise as much as 400% in the coming year, turning a modest $100 investment into $500. Whether one agrees with his projection or not, the underlying reasoning behind his argument deserves careful consideration. Today, I want to examine not only Kiyosaki's views on silver, but also the broader investment principles he promotes, principles rooted in asset ownership, inflation protection, and cash flow generation. Silver is often overshadowed by gold in public discourse, yet it plays a unique and multifaceted role in the global economy. Unlike gold, which is primarily a store of value, silver has extensive industrial applications. It is a critical component in electronics, solar panels, electric vehicles, medical equipment, and advanced manufacturing. This dual role, both monetary and industrial, makes silver uniquely sensitive to global economic trends. Over the past year, silver prices have already climbed sharply, rising approximately 45%. Yet Kiyosaki argues this is only the beginning. His thesis rests on several pillars: historical price suppression, structural supply shortages, and increasing industrial demand. One of the more controversial aspects of his argument is the claim that silver prices have been artificially suppressed for decades. Investigations into major financial institutions have revealed instances of market manipulation, including spoofing, a practice where traders place and quickly cancel large orders to distort prices. While regulatory actions have addressed some abuses, critics argue that the dominance of paper silver contracts over physical silver continues to distort true market value. When paper claims vastly exceed available physical supply, price discovery becomes questionable. If investor confidence shifts toward physical ownership, even slightly, the resulting supply shock could be dramatic. This is the context in which Kiyosaki predicts a potential 400% surge. While such a move would be extraordinary, history reminds us that commodities often experience sudden repricing when long-standing imbalances correct themselves. Kiyosaki's advocacy for silver is inseparable from his broader distrust of fiat currencies. Central banks across the world have expanded their balance sheets at unprecedented rates. Trillions of dollars have been created through quantitative easing, stimulus programs, and emergency lending facilities. While these measures may stabilize economies in the short term, they carry long-term consequences. Inflation erodes purchasing power, particularly for those whose wealth is concentrated in cash or fixed income assets. Kiyosaki has repeatedly warned of what he describes as an approaching era of hyperinflation, arguing that the erosion of currency value is not hypothetical, but already underway. Gold and silver have historically served as hedges against such conditions. Unlike fiat currencies, they cannot be created at will. Their scarcity, combined with global recognition as stores of value, gives them enduring relevance during periods of monetary uncertainty. Recent price movements lend some support to this thesis. Gold has already surpassed several key price milestones, exceeding earlier forecasts and reinforcing the argument that tangible assets are regaining prominence in investor portfolios. For modern investors, owning silver no longer requires storing physical bars or coins in a safe. Exchange-traded ETFs provide accessible, liquid exposure to the metal's price movements. Funds such as the iShares Silver Trust offer investors a way to participate in silver's performance without the logistical complexities of physical ownership. Other options include physically backed ETFs, futures-based products, and trusts that hold allocated bullion. Each structure carries its own advantages and risks, from tracking error to counterparty exposure. The key is understanding that while these instruments simplify access, they also introduce layers of abstraction that differ from holding physical silver directly. Investors must also recognize that silver is volatile. Its price can rise sharply, but it can fall just as quickly. For those with a long-term outlook and tolerance for volatility, silver may serve as a strategic hedge. For short-term traders, it remains a speculative asset. While precious metals play a defensive role in Kiyosaki's philosophy, they are not his sole focus. In fact, he consistently emphasizes that wealth is built not merely through appreciation, but through cash flow. This is where real estate enters the equation. Kiyosaki has long championed income-producing property as one of the most reliable paths to financial independence. Rental income, when properly managed, provides steady cash flow that can offset inflation, service debt, and generate long-term wealth. Unlike paper assets, real estate offers multiple layers of return: rental income, property appreciation, tax advantages, and leverage. As inflation rises, rents tend to increase, while fixed-rate mortgage payments remain constant, effectively enhancing real returns over time. It is no coincidence that Kiyosaki has disclosed owning thousands of rental units. His strategy is not centered on speculation, but on acquiring assets that generate income regardless of market sentiment. Traditionally, real estate investing required significant capital, management expertise, and long-term commitment. Today, that barrier has been lowered. Real estate investment trusts, or REITs, allow investors to gain exposure to diversified property portfolios through publicly traded securities. These vehicles distribute a significant portion of their income as dividends, making them attractive to income-focused investors. In Canada, REITs span multiple sectors: residential, commercial, industrial, and mixed-use developments. Funds such as those focused on apartment complexes, retail centers, or diversified real estate portfolios allow investors to benefit from property ownership without the operational burden. For those seeking even broader diversification, real estate ETFs aggregate multiple REITs into a single investment, spreading risk while maintaining income potential. Crowdfunding platforms have also emerged, enabling smaller investors to participate in real estate projects that were once accessible only to institutions. While these platforms carry unique risks and liquidity constraints, they reflect a broader democratization of asset ownership. When viewed together, Kiyosaki's core message becomes clear. It is not simply about buying silver or owning property, it's about shifting one's mindset from dependency on wages and fiat currency toward ownership of real, productive assets. His philosophy emphasizes preparation over prediction. Rather than attempting to time markets perfectly, he advocates positioning oneself to withstand economic volatility and potentially benefit from it. Whether one agrees with his more dramatic forecasts or not, the underlying principles remain relevant. Diversify beyond paper assets, understand the risks of inflation, and prioritize income-generating investments. We are entering an era defined by economic complexity and uncertainty. Traditional assumptions about money, savings, and security are being challenged. In this environment, investors must think critically about how and where they allocate their capital. Silver, with its dual role as an industrial metal and monetary asset, represents one potential hedge. Real estate, with its income-generating capacity and inflation protection, represents another. Together, they illustrate a broader strategy centered on tangible value rather than speculative optimism. Robert Kiyosaki's predictions may be bold, and time will determine their accuracy. But his core message, that financial resilience comes from understanding assets, not trusting systems blindly, is one that deserves serious consideration. In an age of uncertainty, those who prepare thoughtfully may not just survive the next economic shift, they may thrive within it.